And naturally, the follow-up question to this is, what happens if I marry a put to that leap? Well, you create a structure that's completely different and has a completely different outlook. We had a brief discussion on this last week. A gentleman asked, how can I buy a put? Mark wasn't exactly asking this question that came up last week, but he says, how can I protect a bull put by buying a put? Well, in general, against the same stock, you can't, because you're no longer in a bull put credit spread. Now you're in some kind of ratio put spread that has an entirely different outlook, an entirely different expectation. So we can look at it this way and say, hey, if I was going to buy the 130 call when the stock was at 121, let's go back, 12.15. When the stock was at 121, you're buying an out of the money call for 12.15. But at the same time, I bought the 130 put for September and married it in that fashion. I know this isn't directly what you're asking, but I'm going to show this first, Johan. Now you've created a long strangle position with a cost basis of 25.40, which is the full risk on the trade. Yes, you have profit to the downside if the stock really collapses. Yes, you have two ways to win. If the stock moves down, if the stock moves up as you expected. But you've got this vast area of no man's land. Yeah, that's an expiration. And it's just a small curve here in the middle at the halfway point, but then again, so would be the married put. You create a different structure. What you're asking is that now, instead of buying just the out of the money call with the same expiration that quote unquote is a parity trade, what if I bought an in the money leap call to simulate stock ownership? Where's my chain? Let me go back here and go to the option chain. Let's go to September. So instead of buying the stock at 121.54, on January 25th, I'm going to buy a 0.8 delta 100 strike call that's in the money to sort of simulate stock ownership, stock replacement. Usually you go up to 0.9 or 0.95. We'll just use 0.8. And I'm going to pay a cost of $29.85. And at the same time, which one's this? This is done. Okay. Sorry about that. So at the same time, it's my 100 call, right? Let's say $29.85. At the same time, we buy the same put we would have purchased, that September 130 put at the time to protect the stock toward desired risk, and that price was $16.85, which had the time value of $839.840. Let me do that correctly. Now what you're creating is called an in-the-money long strangle position. Has a risk much higher, almost, double, a little bit more than double, 2.5% of the married put, higher than what the cost was initially of the parity trade 130 call. We might have used same strike and same expiration. You need, not looking at expiration, even looking at the halfway point. We've run examples of this before, comparisons, the in-the-money long strangle versus the married put. Yes, you have two ways to profit, but now you need to see a much larger movement to the upside before you start to see a liquidation profit than the married put, and you need to see a much larger move downwards before you start seeing the profit that you can get on the second side, which you can't get with the married put yet. And in no man's land here in the middle, you're taking a much higher monetary risk at the halfway point and at this, because you're paying into 2 time premiums, not 1. Now, if we want to get just a little bit technical, we talked earlier for Chi about the delta and the Greeks related to the married put. Let's talk about it here as well. We saw in that married put search how when I buy the married put position, I've got the long stock, which we know has a delta of 1. And the married put, which has the put that we bought against it to create the married put, which might have a delta of maybe 0.52 or 0.55, which means I'm still positive delta in this structure. As the stock moves up, I still have a positive delta of 0.48, and for every dollar the stock moves up, the delta of the put decreases. So I'm gaining now 52 cents, now 55 cents for every dollar, now 60 cents for every stock, and so on and so forth. The in the money long strangle position, I had a delta of 0.8 here and a delta of 0.55 here. I'm assuming it's the same, 0.52, we'll call it 0.52. And we saw the delta of 0.8 on the call. This is negative. My apologies for the put, and 0.8. So now the stock moves up 1 point. I'm only gaining 28 cents, then maybe 30 cents, okay? But what we've seen statistically when doing these comparisons is we're starting out more delta opposed, not delta neutral, delta opposed. So as the stock moves up, in order to see the profit targets we'd want on the position, you need a larger movement with the in the money long strangle. A lot of examples we ran in the past. I haven't run recent ones, but a lot of examples that we've run in the past, when the stock move up 3 or 4%, we were seeing a 1, 1.2, 1.5% profit on the married put as we expected. And this in the money long strangle was still at a loss. The delta of the long options took longer to adjust, and you're in this, as we can see, no man's land, where the delta opposition, not delta neutral, the delta opposition was hurting the position more. You didn't start to see a profit unless the stock started to move up slightly more to maybe that 3.5%, 4, or 5% range, depending on the position, depending on the structure, of course. We'll walk through every structure, but we don't have the time to do that. But what do I do when I'm getting into a married put, Johan, or when I bought a long call? I'm buying a position that I want to have low monetary risk in, forcing an ideal size trade on a stock that I'm bullish on for the next 30 to 60 days with a higher bullish outlook for maybe the next 90 to 100 days. That's what I target on my married put positions. We could argue that your September or 1 year out leap long call, same expectations. Not arguing that. Risk reward profile, the same. It's very similar. Okay, we're not arguing that either. You have a known risk, not a low risk on the long call. We have this is the married put. But remember, you don't have I wouldn't call it a low risk on a long call position. That depends on your discipline. You have a known risk. You can make that too large of a risk by over trading. Married put forces me into an ideal size trade. Profit is to the upside at infinite. Risk is known to the downside or controlled to a certain monetary value. We're both bullish that we expect the stock to move up. You and I would both have opportunities if you're in the September 130 call and I am in the married put to sell calls against it to lower the cost basis. In your case, to roll the call up or down to manage. Me with the put, to roll the put up or down to manage. And it doesn't pay a dividend, so that's not a deciding factor in this case, but in other cases, it might be a factor as well. Okay? Now, this is not that same expectation, is it? Yes, it still has infinite profit to the upside, but a larger movement than my initial expectations to why I would have opened a married put. I can profit to the downside, which I can't do in the married put in the initial structure. That's why income method number 12 is there to help with that, Johan, in the blueprint. But this is saying something more along the lines of, over time, I am expecting a big swing, probably in the next 70, 80 to 90 days. And I'm taking on a higher leverage risk because I'm paying into 2 time values. Even though I use that 0.8 delta call, I'm still paying into 2 time values, and that is my loss in this no man's land, and I need a more significant movement to see that profit to the upside or to see the profit to the downside. Strangles have their place, and I did a successful first 6 to 7 months just playing out of the money strangles with a small portion of my portfolio, 1 to 2% on SPY in 2021. I'm sorry, 2022. I'm sorry, 2022. After September, it wasn't working as well. And I've had some successes with it, but not near what I wanted. Why was it so successful? It's because I was just buying an out-of-the-money call and out-of-the-money put on SPY. When the stock started to swing significantly and I saw the market sentiment tool, I rebracketed that entire strangle, took the profit off either on the call side or the put side, reset it to where I wanted with about a 0.3, 0.35 delta for the next 60 to 90 days. moved in that direction, got the profit I wanted, or I saw the market sentiment change again and I moved it. We know what 2022 was in those first 6 to 8 months, and there's a lot of swings that allowed that to be profitable, even with higher volatility in the worst case scenarios. But once the market started to smooth out a little bit, there's still ups and downs, but once it started to smooth out a little bit, that was no longer a profitable strategy. Even though we're going in the money here, where we have some intrinsic value on both options, and we're only risking 1970 of the full 4,970 we paid into it, look at the graph. It's the same expectation. The 30 to 60 to 75 days from now, I'm expecting the underlying to move up from where it is now to closer to the 140, 145, 150 range, probably really the 160 or 170. That's significant expectations. Or even at the halfway point, down to 95, 90, 85, maybe 80 to re-bracket or take adjustments. That's significant. That's not what I'm looking for in the married put position. This is more for uncertain markets, either the in-the-money strangle. Yeah, adjustments can be made in the middle of it. Sam, long-time attendee, long-time great attendee, great questioner, great commenter, great help to me for several years. He's been watching the replays. He hasn't been on live as much, but he's been watching all the replays and sending me emails. He does this kind of structure with us. I think he does the out of the money, as I mentioned, strangle on SPY, and then looks to adjust it with selling puts or selling calls based on the market direction. He's more of a market timer in those cases. And I think his strangles that he uses, or sometimes straddles on SPY or SPX, are only, I forget what he told me, 60 to 75, maybe 90 days out in time, around the same time frame I'm talking about. But he watches it more often than I do. So again, breakdown of that structure. Married put gives us the force and ideal size trade. The at the money bell curve is checked. And the time decay curve is checked. This is the married put. Long call, same strike, same expiration. Satisfies our at the money bell curve, satisfies the time decay curve. You have to perform the satisfaction of forcing an ideal size trade, because the lie of leverage can work quickly against you. And if you're doing to look to the long calls in those cases, and your plan is that, hey, Mike's putting up a 13,000 into the ANET position, I could buy 4 or 5 contracts and only be putting up, 3,000. So 5 contracts would be about $6,000, half of the amount. But now you're risking that full $6,000. It is not forcing an ideal size trade. And if you open 20 positions with 2 or 3 contracts apiece on long calls, you can still lose 40 to 50% on those 20, and that's going to eat up more of your portfolio. This in the money long strangle, interestingly enough, also satisfies the at the money bell curve. Oh, sorry, I had a glitch there. I drew like a little mini bear person or something. Okay, there we go. Because you're buying an in the money put and an in the money call. Okay, I get it. Similar to an out of the money call and out of the money put, which would only have a cost of $19.70, they'd have about the same risk. An out of the money strangle buying the 130 call for September and 100 put would probably cost about the same $19.70. We already saw that skew there. But anyway, it satisfies the at the money bell curve. It satisfies the time decay curve, but also, number one, it doesn't satisfy the fist principle, because we're taking on a 39, 40, 45% risk on the trade. But it also doesn't satisfy the sentiment of why I was considering doing this initially anyway. When I look to open a married put again, I'm looking for a stock that I think has the potential to move up, let's say 3 to 6% in the first 30 to 60 days. And then in the next 30 to 60 days after that, another 4 or 5% potential movement upwards that can be managed with the income methods. Married put satisfies that sentiment. Long call satisfies that sentiment. This, I need a little bit more movement. And although I have the added value of profiting to the downside, it's not matching the true sentiment of why I approached this idea in the first place. I don't think this at all is an apples to apples comparison because of the structure, because of the cost, because of the risk, and because of the sentiment, Johan. Those are my feelings sort of on the comparison of the long call versus the married put position. why they are not directly a parity trade, even though they have the same risk-reward profile. I'm not arguing that, as always. I keep saying that. But we're not arguing that the graph doesn't look the same. We're saying that the risk-reward is not the same and that the long call doesn't apply the 3 core principles as well. Do want to delve a little bit further into that. And there's some older presentations and some recent presentations. Johan, go to the YouTube channel for power options. Use the magnifying glass here on the search, and let's look for 3 core principles. And that's 10 years ago. Okay, 5 years ago. This one's not too bad. This is more recent. 3 core principles in trade comparison. Yes, this is when we're still doing an hour and 15-minute long presentation. We did today, but it was on 4 different topics. This is a full discussion on the 3 core principles and comparing against why not open the married put as a cash secured naked put with a protective put or a calendar put spread? Why not use the in the money long strangle to cheapen the price? And why isn't the long call considered a parity to that position? So we go over that. We look at some positions as we did today. We look at some comparisons of the gains and the losses. I don't think there's a more recent one that's that involved. I'm sorry, there's some summaries I did recently, and I can't remember if it's in this preferred married put structure. I think that's where we talk about the 3 core principles. But yeah, this one breaks down sort of those different comparisons, those 3 comparisons a little bit differently with some other examples. It is a bit long, but you can just fast forward to it because it's full slides, so you can see when I start a new section on comparing the naked put or calendar put, comparing the in the money long strangle, and comparing the long call. And as always, let me know your thoughts on that if you do decide to take a look there, Johan, on those other discussions. But I think both of these are pretty good. The 5 years and 6 years ago, similar topics that I just reviewed, except for these have the slides in them rather than me drawing doodles on the profit and loss charts on power options.